the top stories of the hour. The Finance Department is urging the Executive Department and local government units to become more aggressive in the fight against soaring prices. Finance Chief Diokno made this plea after the Monetary Board raised benchmark policy rates by another 50 basis points to a near 16-year high of 6%. Diokno says monetary authorities have done their part to cool red-hot inflation, and if the Executive Department succeeds in addressing supply-side issues more effectively, there will be less reason for a new rate hike. Diokno says there is a need to implement direct and non-monetary measures to bring down food prices. But the Bangko Sentral is likely to still carry on with its tightening as inflation continues to bite. BSP Governor Felipe Medallia tells Bloomberg that the central bank will probably increase its benchmark rate by a quarter or half a point at its meeting in March. Let's listen in.
0, 25, 50, or 75. I think the extremes could be ruled out. So it has, depending on the data, most likely it will be. It is choice really between 25 or 50 in the next meeting, unless unless we see a actual negative month-on-month inflation. Now, the only way that will happen is that there is significant increase in supply of the products that are now very short. We're seeing that we may have what's called second-order effects. The prices of services are also beginning to rise, despite the fact that the shortages are limited to food.
If the size of the next hike is dependent on the supply, say, of onions, for example, what difference would it make if you move 25 or 50 if you're alluding to it being a supply-side issue?
Well, as I said, there's also there's also some demand-side issues, rentals and restaurant prices. And we're beginning to see the inflation for services rise also. So we think that there's quite a big risk of inflationary expectations being disanchored. So from our point of view, there are two mistakes that we can make. One is raise too much, and the other raise too little. If we raise too much, it's so easy to correct in future policy meetings. If we raise too little, inflationary expectations could be disanchored, and that will be very hard to reverse.
Governor, so I was going to ask you, in fact, where you currently see the terminal rate. Is it 50 above from current levels, or are you alluding to the fact that we might even go beyond 50 basis points from current levels?
That's hard to say. I've been asked that question many times, and I think it's not. I'm not in a position to say what I think the terminal rate will be.
Would you be open to more hikes, I guess, is the other question, beyond 50 basis points if you need to do it?
Yes. That will depend on the data. But the way it looks now, 75 is unlikely. So it's really, looking at the data now, it's the two things that are very unlikely are 0 and 75 in the next meeting.
And here to discuss what this latest BSP move means for equities, we have with us Ariel Santos of Regina Capital. Good morning, Ariel, and welcome to the broadcast.
Hi, good morning. Thank you for having me.
All right, Ariel, so Governor Medallia, of course, raising more than was previously mentioned and flagging the possibility of even more rate hikes. Has this been priced in? What are investors pricing in right now?
Honestly speaking, I think that the market has already priced in this 50 BP rate hike. So I think that they have anticipated it following the release of the 8.7% inflation print, which was read for January. So I think that the investors or market participants have well prepared for the said interest rate adjustment. Hence, the hence the slight profit taking that occurred before the actual announcement of the interest rate hike by the Monetary Board.
All right, and what was mentioned as well is that he was open to 100 or 125 basis point differential with the Fed, supposedly to help the peso, because we saw the peso weakening as well with talks on the Fed that they might actually be more aggressive than was hoped for. What would this mean for us in the equity side or even in the index side if we have a higher than 100 basis point differential with the Fed? Would that be positive for our equities?
I would think that it would depend on how you're going to view it, but for example, in the perspective of an investor, of course you want to get something that would give your money higher interest, for example. So instead of say putting your money in local banks, you would rather put it in US-based financial institutions. But if we're going to talk about on the equity side, this would mean that the discounting rates that we would be using in valuing these stocks would likely give more discount to the equities. Hence, I think that if market participants would want to take advantage of the current market action, they would most likely going to consider taking on a more technical analysis approach instead of fundamentals in the meantime.
Okay. What would the fundamental price actually be? Would you say that our index now is undervalued compared to the levels, that this is just a reaction because of these inflationary expectations and also the rate hikes, but that it might actually be time to be entering, especially since we've pulled back from the highs year to date?
Actually, if you're going to look at the index, its charts, particularly, we can actually say that we are still trading at a premium, especially on its 50-day MA. And likewise, we are still trading at a premium on its 100-day and 260-day MA. So meaning to say, given that we don't have much echo releases to be expected for this week, I think that we are likely going to trade sideways. But if you're gonna ask me if this is the bottom or a solid support that we could be seeing in the next days or so, I would say that there's still a possibility for the index to go slightly nearer at 6.6.
All right, so downside risks here for the index, at least in the short term. Let's talk about the specific sectors that might be affected. No, let's kick off with the property space. This has, of course, already been battered. During the pandemic, they're just in the recovery period, and we were hoping for a rebound this year. Does this expectation of higher interest rates, possibly above it's 6% na, above 6% just to borrow, is this going to be eating in to the bottom line of our property companies?
Well, I can say that it could potentially dent the performance of companies that fall under the real estate sector, primarily because if they would want to proceed with their planned projects for this year, they would have to borrow money at a higher rate, which means that they have to set aside payments for those, and therefore it would likely trickle in and eat their margins.
Okay, and we see, however, that the index has been up by 0.4%. Do you expect some weakness in the sector, or are you overweight on the sector, at least for this year?
For this year, with all honesty, we are still neutral on this sector, primarily because we know that this specific sector would be weighed by the sustained increase in interest rates.
Okay, one sector, however, you are a bit more bullish on, at least we discussed this before the program, is the banking sector. And this has benefited somehow with the higher rates, no, and higher margins. But tell us, is the loan growth going to be weaker because of this higher interest rates? Why isn't the loan growth story or the weakening of the loan growth story impacting the bottom line of the banks?
Some of the banks that have released their 4Q and full year 22 earnings have already provided their guidance saying that they are actually expecting some moderation in loan growth for at least until first half of this year, primarily because some of its clientele are likely going to be prompted to save more than to spend more, given that as we've been mentioning, the higher interest rates, because amid the rising inflation, particularly consumers would rather spend their money, they would rather spend their money in obtaining essentials and so on and so forth, and would likely avoid taking out excessive loans.
Okay, but you did mention that you're looking at two particular banks, BPI and BDO, as some of your stock picks. Why is that, given that you're expecting slower loan growth?
Primarily because BDO and BPI fall under the first-tier banks, and our expectation towards those banks are they would probably be able to bank on the rising interest rates by seeing some margin expansions in their names while keeping their asset quality intact. And additionally, they have provisioned more than sufficient to counter such asset deterioration should it occur.
All right, and consumption stocks. No, you mentioned that we will be tightening our belts here, focusing on the staples. What about the food stocks, the restaurants? We still see so many people eating out, revenge spending. It doesn't seem to be waning. The profits of Jollibee, are still seen as quite big. Tell us your view on the specific stocks, particularly Max's and Jollibee, which are of course the bellwether food stocks.
Based on the fundamentals, Jollibee has some leverage because it has operations outside of the Philippines. Meanwhile, Max's, they are more focused on their local operations. Therefore, I think the latter is more exposed on, say, unfavorable forex fluctuations besides the rising inflation. And because of the rising inflation, of course, Max's or actually any other restaurant stocks, they would be incurring more input costs, which could actually dent or eat out a portion of their margin. So in this case, I think that Jollibee is more protected when it comes to inflation. One, because aside from what I previously mentioned, it's because it's very well known actually.
Okay.
Even if you step out of the Philippines, everybody knows Jollibee.
Okay, so diversification play. And yes, I just had Jollibee in Hong Kong last week. Final question, on the peso side. Do you have an expectation here on how much weaker we might be going in the short term?
Actually, that's very hard to answer. But just based on what's currently going on, I think that the peso could actually go a little bit more softer in the near term.
Okay.
Especially the interest rates disparity that we have with the US.
All right, so still some downside risks here for the peso, trading this morning at 55 spot, 22 the greenback. Thank you so much for those insights, Ariel Santos of Regina Capital.
Thank you.
And for more updates, visit News 5, the Philippine Star, and Business World Online, or visit our website, that's onenews.ph, for more in-depth analysis. You can also catch One News on the Signal Play app. Register for a free account now at www.signalplay.com and stream One News live anytime, anywhere. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.